The best of Money Matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Asia's fixed income markets are navigating a complex global landscape marked by rising protectionism, shifting monetary policies, and persistent geopolitical tensions. Yet, despite these headwinds, the region continues to show signs of resilience, bolstered by relatively strong macro fundamentals, growing domestic investor participation, and a broadening opportunities set across both investment-grade and high-yield segments. As global investors reassess their exposure to developed market risks and search for yield in a more fragmented world, Asia is increasingly being seen not just as a diversifier, but as a core allocation in its own right. So where are the pockets of opportunity in the second half of the year? How are local and foreign investors responding to evolving policy signals? And what risks are still flying under the radar? Well, to find out more, joining me now is Omar Slim, co-head of Asia Fixed Income at PineBridge Investments. Omar, welcome back to the show.
Thank you very much.
Thank you so much for joining us again. Well, Omar, U.S. President Donald Trump's April Liberation Day tariffs hit regional economies, particularly export-driven nations, harder than most had expected. How are Asian fixed income markets positioned to absorb the impact of rising global protectionism and new tariff regimes?
Sure. So in terms of the economic impact is there and will be felt. We are still getting some information in terms of the exact trade deals that were done. And it's not for most countries, not all countries. For instance, for India, it's not. But for most countries, the announced tariffs earlier this month were better in the sense that they're lower than what was announced on Liberation Day. So the economic impact will be a bit better compared to what we had on Liberation Day back in April. Now, when it comes to the Asian fixed income market specifically, the truth is that most of the issuers, so most of the bond issuers that are present in the market, less exposure to the U.S. than other markets. So, for instance, we did a study and we found that less than 5% of the issuers have any kind of exposure to the U.S. or relatively low exposure to the U.S. So the impact on the Asian fixed income market has been relatively low. That's really because of the exposure that these issuers have to the U.S. is also relatively low.
Okay. Well, then which Asian economies are most exposed to shifts in global trade policy, and how might that affect credit spreads or investor sentiment in those markets?
So it's still an evolving situation because, as you know, the trade frameworks and the trade deals and the tariffs continue to be kind of changed from time to time. We have seen a bit more clarity earlier this month when it comes to tariffs, but there is also what the U.S. policymakers have called room for negotiations, particularly for some countries like India, for instance, which has been very hard hit, surprisingly so, I would say, lately. But in terms of the economies that are the most impacted, we see economies such as Vietnam, which despite negotiating tariffs that are lower, it has quite a bit of exposure to the U.S., particularly when it comes to its exports. There are other economies such as Thailand, which is also quite exposed. Other economies, for instance, Singapore has been less impacted. One, because the tariffs imposed so far have been lower. They are at baseline, which is 10%. Australia is another economy that has been less hit because of the lower tariff, also lower dependency on the U.S. But I think here, it's an important but, particularly for places like Singapore, we still need to seek clarity in terms of two segments that have been so far exempted from tariffs, which are electronics, particularly semiconductors, as well as pharmaceutical products, which Singapore is quite exposed to.
Okay. I mean, inflation also remains relatively subdued across much of Asia. So what conditions would need to be met for regional central banks to move more aggressively on rate cuts? I
think we are seeing rate cuts. And only yesterday we saw a surprise rate cut by Indonesian central bank, for instance. And I think we're going to see more of that, not necessarily surprise rate cuts, but a more accommodative set of policies from central banks, with the exception of Japan, the Bank of Japan, which is going the other way for reasons that are specific to Japan. But in terms of inflation, as you rightly pointed out, the inflation is quite contained. Actually, the tariffs might be inflationary in the U.S., but they are deflationary and disinflationary outside of the U.S. and particularly Asia. So there will be quite a bit of room for the central banks in Asia to cut. The concern, of course, is the stability of the currency. So if we continue to see relative stability in the currency market, I would expect more to cut and cut aggressively.
Okay. Then with global rate cuts gaining momentum here, how might yield differentials affect foreign inflows into Asia fixed income assets?
There has been a lot of talk about de-dollarization and the end of U.S. exceptionalism and so on. We don't necessarily subscribe to that view. I think there's still the U.S. market that are very important and will continue to be so. However, what we have seen is a broader need for diversification, and Asia fixed income obviously is one of the areas that has benefited from that. There has been more global asset allocators from outside of Asia that are increasingly looking at the asset class and deploying funds into this market. And I think that theme would remain. I don't think this is a cyclical theme. I think that's a theme that will remain for the next few years.
Interesting. Well, I mean, Asia has often been seen as more fiscally conservative compared to the West. So how do sovereign and corporate balance sheets in Asia stack up in today's environment?
That's a very important point, especially that there has been a lot of fiscal concerns when it comes to some of the developed markets, including the U.S., frankly. Primarily the U.S. actually this year. So the picture in Asia is not uniform. There are some countries that are better than others and other countries that are much better than others. For instance, Singapore is extremely fiscally prudent and is a solid AAA by all three rating agencies. And there aren't a lot of countries that are AAA anymore, particularly from all three rating agencies. Singapore is one of them. So we do see some dispersion when it comes to fiscal metrics, but broadly, I think the fiscal metrics in Asia have been more stable, more steady, and in some instances actually getting better. We saw an upgrade, for instance, for India recently, and we saw announcements from Indonesia. There was some concern about Indonesia, about fiscal prudence, and the latest budget release is, we think, might be a bit ambitious, but it is a step in the right direction in the sense that we are seeing fiscal prudence. So that is a definite differentiator when it comes to Asia, in the sense that we are seeing relative fiscal prudence when much of the world, particularly the US and parts of Europe, are going in the completely different sense of direction.
Then what role does a strong domestic investor base play in supporting Asian bond markets, particularly in times of volatility?
It plays an important anchoring role, and it's a very important role to play both in terms of the stabilizing the market when we see volatility, but also in terms of absorbing the supply of new bonds. So Asia has been a growing money pool, and it's a growing money pool that has traditionally a bit of a home bias, in the sense that Asian investors, which is not surprising, Asian investors do have a home bias in the sense that they like the companies and the issuers that they know, that they understand, and that they can analyze effectively. If we go back 20 years ago, that wasn't the case. It was the Asian fixed income markets were dominated by global investors, and now they are dominated by the Asian investors. And the fact that Asia is a growing money pool will make sure that remains the case for the foreseeable future. If anything, the other global markets have been more dependent on the Asian money pool. So it plays an anchoring effect. It lowers volatility. And unlike when it was dominated by global investors, volatility would lead to more volatility because global investors would kind of rush out. Now what we're seeing is that if we are seeing some weakness, Asian investors would be willing to support the market. And I think that's a very important strength for the market.
So how do investment grade and high yield segments across Asia differ in terms of default risk and return potential right now?
So the Asian high yield market have seen defaults, particularly in the China real estate market, China property developers. And that has been a market that has been hard hit. But outside of that market, when one looks at the default rates for Asia, it actually remains quite low. And even the bulk of those defaults in the China space were over the past few years. Now it has stabilized So when we look at the default rates, it's actually lower than what you see in terms of global peers in the high yield market. On the IG side, we don't see defaults. That's a market of high credit quality, and there's no defaults there. And that has been a market which is quite strong, quite well anchored, and quite steady.
Okay, so where are the most attractive risk-adjusted returns, currently within Asia's fixed income landscape that investors should take note of?
It's interesting you're asking about risk-adjusted, because I think that's one of the main selling points of the asset class, in the sense that what we have been seeing is, over the past few years, and this year included, would be seeing returns that are decent returns, but with lower volatility, even when we compare it to some markets which are perceived to be lower volatility, like the U.S. investment grade market, for instance. So the Asia investment grade has lower volatility while delivering similar, or in some instances, better results. So in terms of answering your question directly, we like some of the financial segments, particularly in places such as Australia and Japan, as well as some places in Southeast Asia. We like some of the corporates, including some corporates out of China, which we think are offering some value. And within the financials, we like some of the insurance segments, as well as the commercial banks, which we think are on a relatively good fundamental standing, as well as offering some value.
Overall, then, what's your view on the outlook for high-yield bonds in Asia, especially in light of recent recoveries in property or even industrial sectors?
I think the Asia high-yield segment as a whole is one of those markets that is still offering some spread differential. When you look at the fixed income markets broadly, you see spreads that are generally quite tight, particularly from a historical perspective, and you see that there has been almost a one-way tightening in terms of credit spreads. I think Asia high yield, again, because of the China property defaults, and again, they were very centered in China property, we have seen some widening and in some cases indiscriminate kind of selling, which to us represents opportunities. Now, over the past year and a half, 2 years, the market has been recovering quite strongly, I would say. But I still think that there is some room for further spread compression, particularly given the fact that the default rates remain quite low. Frankly, when you exclude China property and so on, for some quarters, defaults has been really zero. So that's a market that I think still has some room for spread compression. Of course, that's a generic statement, and I think that there are some names that are better than others, so credit selection is key. But as a whole, it's a market that still has an interesting spread differential, particularly against global markets.
Well, on that note, how can investors best approach duration and currency exposure when allocating to Asian bonds in the second half of the year?
When it comes to duration, the duration and the interest rate sensitivity of the rates will be very much dependent on some of what the major central banks would do. Chief among them would be the Federal Reserve. So we think that the Fed will be cutting this year. We have said that we think that the Fed will cut less than what was expected, and we continue to think that that's the case, and the market gravitated more towards our view. So we think that there's a cut likely in September, which is priced in, and another likely cut for the fourth quarter. So duration has been stabilized by that, and we saw some yield retracement lower because of that expectations. The currency markets have been quite interesting. We have seen substantial dollar weakness over the first half of this year, and the Asian local currencies have performed very, very well, almost across the board, almost, not entirely, but almost across the board. And we think that this is perhaps the bulk of the dollar weakness is behind us, but we continue to think that there are some Asian local currencies, including Singapore, for instance, that is ripe for some strong performance. So I think in a nutshell, we have seen over the past few years almost a one-way trend where the dollar was gaining strength, and that has been reversed this year, particularly in the first half of this year.
Right. Some great insights from you there. Well, before we let you go here, Omar, looking ahead, what are the key catalysts or inflection points that could significantly reshape Asian fixed income markets in the coming months?
For the Asian fixed income, what will be very important is to continue to get clarity when it comes to the U.S. policy. So that would be one. The second one would be what we see in terms of the impact of those tariffs For the fixed income market, I think the impact, the economic impact, or the fixed income market will feel less of that economic impact, but I think it will still be important when it comes to sentiment. And the third is, I think we're seeing a bit more issuance this year in terms of new bonds, and that has been an interesting development, which we welcome. Some local currency markets like Singapore, but also in the US dollar. So we expect that to continue in the fourth quarter, and I think that should provide us with more opportunities.
All right. Well, thank you so much, Omar, for your time and your insights today.
Thank you.
Thank you. That was Omar Slim, co-head of Asia Fixed Income at PineBridge Investments. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.